So I've been trying my luck at this whole investing game, trying to dive deep into many different investing philosophies, whether is it value investing, and in this value investing, there's quality investing versus nets, and then growth investing, and then momentum investing, etc., etc. You name it, I probably have read about it to a certain extent. And in my pursuit of trying to find this quote unquote best way to invest, it has been an arduous journey. Until now, I still couldn't find an answer. And I can tell you that even in the entire financial history and literature of the stock, since the existence of the stock market, there is still no right answer or right formula or right process. If not, every single other hedge funds out there will be implementing the same exact process to try to generate alpha and to beat the market. But clearly, more than 90% of them don't even beat the market. Is there really even a perfect formula or a secret formula to beat the market? I think the short answer is no. But the long answer is a lot more nuanced than that. So before we dive deeper into trying to understand why this multi-trillion dollars wealth management industry that attracted so many brilliant minds of the world still failed to beat the market, you forgot something, which is to gently smash the like button. So don't forget about that. I think that's more important than trying to beat the market. Trust me. I've forgotten. New year, new sign-up rewards. So Webull's new welcome deal for the start of 2023 has never been better. So you can get up to 150 US dollar trading vouchers if you fund and trade your Webull account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade on a stock or ETF and one mutual fund, coupled with buying one option, and you will get to enjoy a whopping 10.5% return on initial capital. So for those of you who are still considering sitting on the sidelines, I don't know what's holding you back. So when the markets are slowly selling down and S&P 500 just keep grinding downwards, I think it's a good opportunity to start dollar cost averaging into the markets. And you can even get an additional 150 US dollars to do so. So Webull prides itself on zero commission trading, and you can stop paying all the redundant commissions and use it to buy more shares. So recently, they've also allowed for a zero fee subscription and redemption of mutual funds on their platform. So don't let this opportunity slip away so easily. Link to sign up is in the description box down below. Thank you Webull for sponsoring this video. Now, before we even pledge allegiance to any specific strategy, whether is it value investing, growth investing, trading, momentum, whatever, let's try to first understand fundamentally what is good investing. So I think this short clip from Howard Marks really paints a lot of picture, and it probably will give you a better understanding of what good investing looks like.
I'm a value investor. I try to figure out the intrinsic value in a situation. I like to buy if the price is low relative to the intrinsic value. I like to sell if the price is high relative to the intrinsic value.
So take note here, it's quite interesting because when people like to compare value investing across the spectrum, there are really many different shades of value investing, even in the value investing community. You have people like Buffett. Buffett likes to hold, and he said that his holding period is actually forever. So he likes companies like Coca-Cola, Apple. He probably wishes to hold them forever. But in this case, you have Howard Marks, who probably identifies as a quote-unquote value investor as well, but he claims that he sells when the company or his investment is above the intrinsic value. So there's just a bit of the nuance that you have to take into account when you listen to many of these investing legends.
The main determinant of that relationship, it's emotion, psychology, investor sentiment. If people are excited and bullish and optimistic regarding to the asset, chances are its price will be above the intrinsic value. And of course, that is a source of danger, and that is a source of below par returns. But if the investors are pessimistic and unexcited and have given up on an asset, then chances are perhaps that its price is languishing low relative to the intrinsic value. And that is a source of great opportunity. So we want to buy when people are depressed and pessimistic, and we want to sell when people are optimistic and excited. The difficulty is that many people's emotions or psychology, I use the terms interchangeably and it's not easy to say why, most people's emotions fluctuate the same. We're all subject to the same influences. We all read the same headlines. We all hear the same stories on TV. We all see the same economic reports. So the things that get other people excited and positive and optimistic would tend to get us excited and positive and optimistic. So the things that force people to bid securities up and make the prices high, those same forces would tend, if permitted, to make us excited and to buy when prices are high and depressed and to sell when prices are low. So the point is that if your thinking and your emotion is the same as everybody else's, then you cannot do the outthinking and what I call the second level thinking, which is required to act against the herd. The common word is contrarian, and to sell at high prices, which are high because other people are optimistic, and buy at low prices, which are low because other people are depressed. We have to be aggressive when people are depressed and defensive when people are excited.
So essentially, I actually resonate quite deeply to what Howard Marks has to say in this short clip. That's why I kind of try to buy securities when it's essentially depressed. And for those of you who have been following my portfolio, I like to accumulate assets, or I like to accumulate securities when the narrative around the stock is deeply concerning. So you have companies like Meta, like Amazon, massive layoffs, crappy investment cycles. Chinese tech companies, Chairman Xi lost his way. China is no longer that economic miracle. And in this case, even China banks, they are in the middle of this entire property crisis. You just take one look at my portfolio. Some of my friends actually expressed concern saying that, am I okay? Why are you buying into companies like these? And do you want to just burn your money or burn your hard-earned money in all these industries? And hey, don't forget, your money can go to zero. I think firstly, there are two key areas of concern here. Firstly, it's the valuation part. So I think Howard's actually talked about it, or actually described it extremely succinctly. If people are excited about something, they will inevitably bid up the stock price and bid up valuation. So by entering at a subpar valuation, or by entering at a lower valuations at the lower end, you already give yourself that margin of safety. That's the first part. And on the second part, you have this idea of lethality risk. In this case, losing everything. And essentially, the quality of the company being compromised. And in this case, I like to always draw the example of Intel. So Intel has been a pretty popular stock within the value investing community because Intel has a low PE ratio. It's one of the juggernauts in the entire semicon industry. And now, with the entire semiconductor space being upgraded to a national security level, with the US government essentially backing many of these companies, it looks good as an investment opportunity, right? I think the last I checked, the PE was like 6 to 9. So why would you not invest as an investor? I think then comes the aspect of quality. And in this case, firstly, I feel like Intel is a little bit out of my circle of competence. Even though I do invest in companies like Taiwan Semiconductor, it's a little bit different. The nature of the business is the same, but their strategy is different. And in this case, Intel is really speaking from a position of weakness, especially in their current investment cycle, with a huge level of uncertainty. But many of you can argue that, hey, you are doing the same with Meta and you're doing the same with Amazon, right? They're in their investment cycle, there's a huge uncertainty ahead. I would argue that it's quite different, but that is my own assessment. So that's why you have to bring the qualitative assessment into the picture again. And you can't really just judge everything based on quantitative figures. And many of these numbers, which is valuations, they are most likely backward looking because those are the numbers being put forth by the companies based on the past several quarters or several years. So you as an investor, you have to make an intelligent guess into what the business is going to do in the upcoming 3, 5, 10 years, and then enter at a valuation that you are comfortable enough. So before we continue this discussion about valuation and what are the key business metrics that you should look at, I'll just point you to a very short extract. It's essentially a collab video that I did with Bunti, and I lay out my arguments where we essentially try to discuss which is more important, valuations or return on invested capital or ROIC. And many investors like to use ROIC as a benchmark for quality. So I'll just play a short clip. To me, my fundamental understanding of investing, or at least when you pick the two important factors, right, you put it on a spectrum. So it's always a quality versus valuation trade-off. Assuming that market is largely efficient, and this is based on my own assumption. So I believe that, I don't believe that we are strong form efficient, but we are relatively efficient. So if we are in an efficient market, if there is a high quality company, the valuations tend to be high as well. Like the market is not stupid to ascribe a cheaper valuation for a high quality company. So here comes the issue. Now you sit on this spectrum, you start off in the middle. So whether you tilt towards valuation or you tilt towards quality. Personally, I like to tilt more towards quality. I like to tilt towards valuation. So meaning that I would like to think that even though I say that I'm a long-term investor, I'll hold very long, right? But I still need to have a reasonable amount of margin of safety, and I don't like to overpay for many stocks. So a lot of my quote-unquote stocks are, I mean, a lot of people like to say it's like value plays, right? Because it's cheap. You look at the valuations and stuff like that. So that is the context of this discussion. So now I think back to the numerical example, right? I totally get the numerical example. I get, because it's all math. Yeah, you're manipulating math, ma. So you're just showing me that in the long term, if you hold 20, 30 years, as long as you determine the ROIC correctly, or as long as you determine the quality of the business correctly, you tend to do quite well, even if you overpay in the short term. And I totally agree with that. I think here comes my issue. I know that I'm stupid as an investor, so I don't know. Actually, 5 years is a very long time frame already. To say that I know for sure that this company, X company, Y company, for 20 years is going to continue outperforming, and say that their earnings growth is going to be good, I think it's also a little bit overconfidence on my part if I think that, okay, I bet that this company is good. So from that perspective, right, I only can control a few things, right? Number one, I can control my entry price. If this quality company is very expensive, then I don't buy lor. Like there are 1,001 companies out there. Why I need to buy quality companies? That's number one. Number two is I cannot assess quality objectively. Meaning to say, I can give you a lot of high quality companies today. Microsoft, Amazon, Apple, Tesla. How do I benchmark them? So Microsoft quality is 8. Amazon quality is 7, so I put more money in the micro. I can't do that. Like there is no objective qualification. And even if in the same industry, so let's take for example the automobile industry. So let's assume that Tesla is still an automobile industry. Let's say Tesla is cream of the crop. It's 10. So where's Ford? Is Ford 5, 6, 7, 8? I don't know. So that's why this quality discussion becomes very iffy or very debatable, you know, like you can argue until the cows come home and use open Excel and calculate, but we still don't know how do I put it. So that's why I always revert to something that I can control, which is my entry price and the valuation. This is hard, ma. You cannot run away from the numbers. So that's just my perspective on that. And then I think last point I want to make, back to the quote, right? I think Buffett always like to use, right? Oh, buy a wonderful company at a fair price, a fair company at a wonderful price, rather than a fair company at a wonderful price. I think this quote a bit misused sometimes. A lot of people like to use that. I feel like it's an excuse to just overpay for companies. And even though we like to talk about that, right? Then Buffett recently, I think, bought into HP, right? Is HP a quality company? Is it a wonderful company? I think we leave it up to debate. But he did buy a huge stake in HP. And the idea is very simple. The free cash flow yield is crazy. The valuations is dirt cheap. And HP is probably not going to go anywhere. But is it going to compound earnings at 15-20%? I doubt so. I think it's probably a magic company that won't die, but it just stays there. So then here comes the question. So do you believe in what Buffett do, or do you believe in what he say? And sometimes what he say is a lot of nuance there. So you need to be more discerning when you quote him and just say what he says. But yeah, that's essentially my entire investing philosophy and how I look at investing in a nutshell. But I think this time around, I'll just like to play something about how Damodaran actually looks at valuation and how he looks at companies. And in this case, for those of you who don't know this guy, he's essentially he's called the Dean of Valuation. He's essentially an NYU prof. I think he teaches undergrad and MBA, and he teaches valuations specifically. So let's see what he has to say.
You're known as the Dean of Valuation, and I wondered if you could take us through how you would value a business like Tesla, not in ridiculous levels of detail, but think of a company like a Tesla or an Amazon that you've analyzed many times.
Yeah.
Can you just give us a sense of your linear process and what the most important things are to focus on? Because one of the things you've written about, you once said very eloquently, the problem that you face in investing now is not that you don't have enough data, but that you have too much. And I'm curious, when you tackle a big, complicated business or a fast-growing business or any business, how you simplify, how you focus on what really matters, how you clear away the noise. What are the 2 or 3 metrics or measures that really give us the most benefit? And I think this could be really helpful for our listeners, because many of us are suffering from what you call data overload, the sense that there's just too much information. We don't know what to do with it.
I'll give you a compressed version of my valuation class in kind of very simplistic terms. Every valuation tells a story about a company. In the case of Tesla, for instance, is a story you're telling of a car company? Is it a story of a green energy company? Is it a story of a battery company? Is it a story of a technology company? That story is actually the starting point for this process, because the story is going to frame every choice you make. And here's what I mean by every choice you make. Now, ultimately, the value of a business, if you think about it, comes from 5 drivers. 3 capture the business model. First is revenue growth, which captures, are you a small, are you a low growth business or a high growth business? The second is operating margins. Are you in a profitable business, or so what kind of business are you running? As an example, this, if you're a manufacturing company, even a very good manufacturing company, your best case scenarios, you might make 15 to 20% margins. Why? Because you got to make the car to sell it. You got to make the machine to sell it. In contrast, if you're a software company, your margins can be 40, 45, 50% because the extra piece of software costs you nothing to make. So that operating margin captures the profitability of your business model. And third, growth needs reinvestment. In machines, equipment, if you're a manufacturing company, in R&D, if you're a technology company, in customer acquisition. So revenue growth, margins, and this reinvestment measure capture the quality of your business model. So when I build spreadsheets, I don't have 500 line items. I basically have those 3 line items. And what it does is it focuses your attention. Remember, you started by saying we're faced with too much data. And the part of the reason we get lost is we start looking at data without any sense of where does that data go. So you get one piece of data, it leads you down one rabbit hole. You take another piece of data, you go down another. So it's almost like you're collecting information and putting it into folders without any organizing system. So by the time you're done, you have 15,000 items you've collected and nothing to organize them. Now, the way I think about data is I have 3 folders on my desktop. One is a growth folder, a profitability folder, and a reinvestment folder. So as I read about Tesla, for instance, every story that I read that tells me about its growth potential, and that could be a story about how many cars Tesla sold in Norway, how successful it's becoming in a particular, how many those go into the growth folder. Any stories I'm hearing about its improving profitability, that the gross margin numbers that might come out, or something they're talking about how they're cutting the cost of making a car go. So each piece of information, as I look at it, goes into a folder. It organizes the data, which means that the data is going to end up as a number in my valuation. Because if you cannot take all of this disparate data and create a focus number, it becomes, on the one hand and the other hand, and ultimately you really can't come to any conclusion. So I start with a story, I collect the data, and along the way I finesse my story. When I'm done, I actually have a sense of this is the kind of company Tesla is. In the case of Tesla, my most recent valuation, which is about a year ago, I described them as perhaps, I mean, I saw a pathway for them to becoming not just an electric car company, but perhaps the largest automobile company in the world in terms of cars sold. It's a very upbeat story from a Tesla investor standpoint, because the world that I'm describing, almost every car sold ultimately becomes an electric car, and Tesla has a big market share. Lots of ways to push back on that story. First, the cost of making an electric car might continue to build up, and you might not want to spend that much money on a car, so you might not end up with that. The second is you might have lower cost producers like NIO that might end up dominating the Asian market. But my end game here is to tell a story, convert to numbers, come up with the value. With this incredibly upbeat story I told for Tesla, the value that I came up with was, I think, $600 per share. The stock was trading at $1,400. I had taken every conceivable upbeat part of my story and built it in. And my reaction was, hey, if you want to buy Tesla, go ahead, right? But from my perspective, with my story and my numbers, I can't justify buying Tesla at 1,400. So the key is not to get lost in too many details. And when we talk about metrics, look for business metrics. Investing has pricing metrics, PE ratios. They're all great for saying, what is the market paying? But the key to value is understanding what is the business worth. That's why you want to look at revenue growth and margins and reinvestment, because those are business metrics. So keep the pricing metrics, but you got to bring business metrics into your investment choice.
So I hope you enjoyed the short masterclass in how you look at valuations, how you look at investing in the stock market, and essentially my own investing philosophy. So investing is a craft. You have to put the hours in and you can get better at it. With that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!